Welcome back. This is the fourth installment of Startup Law for Co-Founders. Good to see you again, Francesco. I'm excited for this one, investors and capital raising. This is coming after we've already discussed a couple other really fundamental pieces of this journey, right? We've talked about incorporation, where, how, when, finding a co-founder, and some of the kind of foundational mindset pieces to that relationship. You've started pooling resources, team members, and now this kind of additional group of stakeholders and resources, investors and capital. Right at the outset, Francesco, kind of set the frame for what an entrepreneur should be thinking about when they're beginning this chapter of this journey.
Yeah, thank you, Chris. So, there's capital raising is obviously a fundamental access to capital. To build a business and grow a business is obviously fundamental part of the startup journey. Like, what is different about a startup from a small business is that it is an early stage company that is looking for a scalable business model, and scaling requires upfront investment. It requires upfront investment to gather the team and resources and assets that are necessary to generate value for users and customers. So the core piece that founders, owners need to be thinking about, with capital raising is really there's the is this a business, and am I the kind of founder that wants to have outside investors, and is this the right kind of way to grow for me? Because it isn't the only way to grow. One can grow organically using revenues that are generated from the business. You could finance your own company through outside consulting work and and loans and things like that. So it may not be. So that's kind of question number one. And then related number two question, the sort of second set of considerations is to understand is that when it comes to raising money, there's no sort of cookie cutter model to it, that you can really structure a capital raise in any number of different ways, using any number of securities in terms of kind of how much you're raising, what are the rights and benefits you provide to investors. Are you going to share control or retain control? There's really a very, very wide variety of ways to do capital raising to match it up with the goals and vision and objectives of the founders, the kind of plans and the exit strategy of the founders, and then kind of mapping that with finding investors where, the interests are aligned and overlapping, so that you're creating a partnership that makes a lot of sense for all parties.
At the outset of the series, you talked about the corporation as this kind of legal technology that enables this sort of thing to happen, to pool resources, to bring in partners and stakeholders. Right. It seems like so much kind of in the news media, or the popular perception in the startup space, is that you have to be a unicorn, you have to go this traditional route through Silicon Valley VC firms. But what I mean is that actually is just one of many, many different options and routes that are available for an entrepreneur when they're starting this process.
Yeah, that's very true. I mean, so the venture capital route is appropriate to, if you're looking at the entire universe of business, a really relatively small slice. I mean, really, I don't know, maybe 1% of all businesses. They get a lot of attention because when they are successful, they're impactful in our culture, like Uber and WeWork. We see these brands all over the place and so forth. But there are really, obviously, thousands and thousands of other smaller businesses that are serving smaller markets, regional markets, less fancy markets, that are raising capital, from a very broad variety of different kinds of sources. So venture is very much oriented towards companies that are addressing a very large target market, and then have that potential to become very big. That's their basic business model. But not every business is, not every business is designed to be that large, or, founders may not want to become that large, or the market may not be that big. And this absolutely 100% fine. I mean, it's not, it's just the nature of things. There's a curve. So I think that it is important for, kind of owners to understand that that model is not, it's not the only one that's out there. And I think most do.
Yeah. Even then, I do hear a lot from people, this kind of description of the fundraising process as a hard thing that they're doing. It's difficult. And maybe there's some kind of information asymmetry happening for them where they don't necessarily know where to look. But that may actually not be the hardest piece of this journey after all, because some of the early investors are often people that you may know already or close kind of in your network.
Yeah, in a lot of cases, with, an early stage startup founder, maybe doesn't have a tremendous business, kind of background or history, maybe a first time founder, the kind of best place to look is people in their immediate network. And then kind of starting out with the people that and then emanating out from there and getting introductions from there. And, in our practice, as Chris, we've seen founders be really successful with raising that initial capital that's required to build and validate a product with initial users, using a colloquial term for it as a friend and family round. But it really it's just referring to founders who are using their social capital, their already existing relationships, to find people that are willing to take a chance and take a bet and believe in and want to support the founder and what they're doing. So that is but it's a hard thing to do, I think, for obvious reasons. It's a little bit uncomfortable to be making that ask. So you're kind of flexing new muscles, and when you're going out asking people for money, it's sort of it's kind of an unfamiliar thing. So it takes some getting used to, and and that's, but on the other hand, building those muscles of making the ask and being okay with the yes or no and moving on to the next conversation is an indispensable part of like building the resilience to kind of pivot, adapt, and keep moving.
So how does an entrepreneur go about kind of setting the groundwork for this, identifying the investors, identifying the ways that they want to reach out to people in their network or kind of in the field that they're operating in?
Yeah, sure. I think, we did the Get Funded ebook that we put together, which everybody should download because it's going to be more comprehensive than this conversation. But it kind of lays out a process for planning and thinking about a capital raise. And I think that in planning the capital raise, the process of planning it and thinking it through will really generate a lot of those answers for founders. So step number one is kind of thinking about, essentially like, what is it that I can and want to accomplish with a capital raise? If I had X amount of money, how would I spend it to generate a return on that money? It's kind of like a business plan for that, for the round of funding that you're planning to raise. So let's say you kind of want to, you're thinking about raising money so you can build out your sales and marketing team. How would you spend the money? Who would you hire specifically? How much would it cost to hire that person? What kind of other assets would you need to be building, marketing collateral and so forth? And kind of building out building out the kind of model on the kind of projected expense side, and also on the projected additional or incremental revenue side, and building a cushion into that, and planning for contingencies and so forth. And that kind of planning process, and becoming really familiar with and having a deep understanding of your business, the financials of your business, the market that you're addressing, the challenges that you're likely to overcome, the weaknesses in your plan, and kind of how you're thinking about those weaknesses and how you might address them. But really developing that kind of intimacy of understanding your business and your market is just a great foundation for then beginning to have some just really kind of candid conversations with prospective investors about, this is what you want to do, this is where you see the growth potential, this is what you see as the potential return and opportunity, and it and it's in that kind of a candid exchange that you discover if there's an overlap between what you're doing and the goals, values, and interests of the investors. Now, you can kind of shortcut that process by researching your investors, and there are databases and public resources that we point to in the book where you can learn more about angel investor groups and angel investors individually, as well as institutional funds and venture funds, to understand what their interests are, what their investment thesis is, what they have invested in the past, what stage of a company they generally invest in, and so forth. And so using those kinds of tools, as well as your own professional network, you can build a target list of investors that you already know from that work is kind of pre-screened to some degree, and that'll help a great deal in both kind of saving time, but also impressing the prospective investor that you've taken the time to do that preparation.
Yeah, definitely. And speaking of preparation, another big component of this is when you're asking for money, receiving money, there's a compliance side that can often probably feel a little bit complex and overwhelming, having federal regulations from the SEC, state level rules that may or may not apply. What should an entrepreneur be thinking about in terms of the securities compliance framework around raising capital?
Yeah, well, so a couple of things. I mean, the first thing to understand is that offering and selling securities like stock in your company, convertible notes, safes, and really any investment security, even loans that meet certain criteria. So any of those kinds of securities, offering to sell them and selling them is regulated. There are federal rules about it, and there are state level rules that operate concurrently. So if you're making an offer, you have to make sure that you're doing it in compliance with federal law, and then in compliance with the state law in which you're offering or selling securities. So if you're doing a multi-state offering, you need to be aware of that. Now, often that is not as complicated as it sounds, but you do need to know in advance, your compliance approach and strategy, so that you are structuring the offering and you're offering documentation and materials, and the way that you're conducting the offering, that you're doing so within the confines of the compliance strategy that you've selected. So, for example, there's a private offering exemption under federal law that says, and this is just a capsule summary because I don't really want to go into the details here, but the capsule summary is, if you're raising below a certain amount and you're not advertising it to the general public, and you're only selling the securities to wealthy investors, accredited investors, then we're going to take a pretty hands-off approach to regulation, because you're not you're not going out to the average investor that needs a whole lot of protection, and you're not raising a lot of money that's likely to impact tons of people. And so there's a more hands-off approach. On the other hand, if you are looking to raise larger sums of money and you're looking to market and advertise the offering, and you're looking to sell the offering to average people that are, not necessarily, don't have a certain level of net worth, then the regulatory aspects are going to be more rigorous, and you may have to prepare a more extensive set of documentation and disclosures for prospective investors, and give all the investors these disclosure materials and so forth. So it's important to really understand at the onset, at the planning stage, how you're going to do the offering, and then structure the offering consistently.
So what I'm hearing there is, kind of a couple of key points. The size of the offering is going to impact the level of disclosures and regulation scrutiny that you have, as well as the kind of sophistication and acumen of the people that are investing, and both of those kind of working in tandem.
Yeah, as well. And also whether it's public or private, in other words, whether it's advertised broadly and open kind of indiscriminately to anybody, versus private offering to kind of like invitation only type of thing.
Friends, family, people people you have a relationship with.
Yeah, right.
In that compliance strategy, it sounds like you're going to come away as well with a pretty clear understanding of the terms that you're offering, the instruments that you're going to be using, how the kind of basic mechanics are going to operate.
Yeah, there's in some cases, there's not a hard and fast rule about this. So I've seen it done, and we've done it in a couple of different ways. So for example, a lot of times in starting a capital raise, a founder or founders will have general parameters for what they're going out for. So for example, they might say, we're raising $750,000 in a convertible note with this discount and so forth. And that, it makes sense where we can just basically put together a proposed offering and go out with it. In other cases, we might go out with really more like a range of potential, you just kind of like a general range or a set of valuations and sort of a general parameters of what we're thinking about, and for the purposes of having initial conversations and getting some initial feedback, and developing some more clarity about how receptive the market is. Now, in still other cases, like for example, where you're doing a public offering, or an offering that relates to a very specific project, where you really have like a private placement memorandum, a complete set of disclosures, and a comprehensive set of the legal documentation, like all the terms of the offering kind of already baked in. That's still another model, and which one you use is really depends on the particular circumstances. But in general, the key thing to understand, or the key thing for founders planning a capital raise is really to build an offering that makes good sense for the company, makes good sense for the founder, and also works for the investor in terms of generating a return. It's consistent with their needs for an exit in whatever time frame they need to exit in, and so there's a lot of different ways to do that.
And that's kind of the starting point. I think a lot of entrepreneurs have seen or have worked with a term sheet as kind of a starting point, a jumping off point for those conversations. Is that
A term sheet is is a it's a summary of the material terms that you're proposing, and it's a good thing to prepare as a basis and framework for conversation.
In addition to that, another thing that that is discussed a lot, that entrepreneurs work a lot on in these early stages, is a pitch deck. What do you see in those materials in your work with founders as they're going out to have some of these conversations?
Well, yeah, the pitch deck is it's kind of like the I guess the way I think about it is it's kind of a visual and condensed presentation of the opportunity and the business plan. It's the value, I think, of a pitch deck is for the founders in really condensing and understanding in very fundamental ways what the nature of your business is, what the nature of the opportunity is, what is the pain point you're addressing, and how are you addressing it in ways that are different, that are adding value? What is the size of the potential opportunity? What are your competitors doing? Why is your team well suited to execute on the plan? Those kind of getting really clear about those core differentiating factors in your business is a very valuable exercise. And the pitch deck is presenting that basic fundamental information in ways that are intuitive and visually compelling. I don't know. There's statistics about how little time people spend actually looking at pitch decks. So I don't know. I can't really say much about how important or not important they are. I think that they're important for the reasons that I just explained. Ultimately, you as a founder need to be able to talk about your business in compelling ways, and getting the pitch deck in place is practice for that, and requires the kind of deep thinking that I think is really helpful. Ultimately, what's really helpful in doing your capital raise.
Yeah, that's interesting. You mentioned deep thinking. So much of this work in kind of finding the investors, researching them, what their thesis is, if there's a fit, putting together the offering materials, the pitch deck, requires a lot of clarity and kind of putting the brakes on the speed that is often kind of the default mode for a founder. The move fast and break things kind of model is great if you're trying to develop products and get an MVP out the door. But for some of this, work about fit and pooling resources, bringing people in, does require clarity, and that requires kind of a slower pace of movement.
Yeah, I don't know. I mean, I see the process of growing a business as very much about kind of moving, pivoting, adapting, and especially in the early stages, it's very difficult to kind of do a whole lot of planning when you're really just kind of figuring things out as you go. And then as you kind of get your product market fit, and you really start to understand what you're in the business of doing, and you start to really understand what the processes are that you need to improve and get in place, and how you're selling and all of that stuff, then things become more, execution becomes kind of more of a predictable and plannable kind of process as a company matures.
Sure.
So a capital raise in those later stages is going to look, different for that reason than in the earlier stages, where, there's a lot less information, but it's still it's still necessary for founders to talk about how they are see the lack of information and how they plan to navigate it and what direction they're moving in, so that, investors need to feel like their money's in good hands, that the bet that they're taking, they're getting, any early stage investment is much riskier, right? For that reason, because of all the uncertainty. And what I think investors are really looking for is that they're betting their money on a team and a vision that has at least a reasonable shot at navigating through the uncertainty, finding the gold, and bringing it, carrying it forward to the next level.
It's a really interesting process, and a really, whether you're the entrepreneur, the investor, wherever you are kind of as a stakeholder, an exciting process to go through to find that gold.
Yeah. Oh, it is. It's a very cool journey. I mean, the entrepreneurs we work with are, they're just creative, resilient, visionaries. They have, they have a vision for how they want their companies to look, how they want the world to look, and they're kind of groping for it one day at a time. And it's challenging. It's challenging. I mean, we're doing it here with our law firm and practice, and it's both challenging but also very, very kind of cool and gratifying.
Absolutely right. Part of that gold, kind of to tease to our next episode, is what this company is kind of built around, what the vision is about, the tools and services, products that are going to make that happen. And often that involves some form of intellectual property.
Yeah, absolutely. That's our next focus is, intellectual property, which is, really like the intangible, the assets, the knowledge assets that create value in the business, and how to protect it, protect that, and think about intellectual property as you're building and growing the company.
Yeah. So until next time, as Francesco mentioned, the Get Funded book is on our website. It provides more depth and color about this conversation. And we'll see you next time to chat about IP. Thanks, Francesco.
Thank you. Thanks so much, Chris.